Hello and welcome to 5-Year Club video number 345. Am I right about that? I am. It's 345. Amazing. All right. Tonight we're just going to cover a Motley Fool article, not because I think Motley Fool is the best possible source of investment advice. I don't. I think they're a little bit trashy, a little bit promotional. But because this article will give me an excuse to just bring up a topic that you may not be familiar with, and then you can, get educated about it a little bit. Not that I'm an expert. I'm not, but I was introduced to it in the book The Future for Investors, I think, by Jeremy Siegel. And I think it could be interesting for you. These three companies are buying back the most stock. These S&P 500 technology titans are buying back tens of billions of dollars worth of their own stock this year. A strong economy and tailwinds from tax reform have caused cash to swell on corporate balance sheets, and that's led to increasingly larger share buybacks. In the third quarter of 2018, S&P 500 companies bought back a record $204 billion of their stock, up 58% year over year, according to the S&P Dow Jones indices. As a result, share repurchases by companies in the S&P 500 totaled $583 billion in the first 9 months of 2018, putting buyback activity easily on track to eclipse the full-year record $589 billion spent on buybacks in 2007. The 20 companies that bought back the most shares last quarter accounted for 54.3% of all S&P 500 buybacks, the highest since 59.8% in the first quarter of 2010. However, share repurchases were greatest for these three companies, all in the information technology sector. Well, just backing up a second, this is kind of the last peak of buybacks was in 2007. That was right before the crash, which makes me want to see how stock buybacks correlate to recessions, but we can do that at a different time. And my cat is insane. Okay. The 20 companies that bought back the most shares last quarter accounted for 54% of all S&P 500 buybacks, the highest since 59% in the first quarter of 2010. However, share repurchases were greatest for these three companies, all in the information technology sector. I already read that. Great. Okay, so we got Qualcomm, which is a mobile chip manufacturer. I think that's what they do. That's what I know them for. We have Apple. Obviously, they do a lot of things. Make the iPhone, make a bunch of computers. And Oracle. Own the iTunes Store and the App Store, obviously. And then Oracle, yeah. And they do a bunch of database stuff. Mostly, I think, enterprise database stuff. What's my cat doing now? I'm suspicious. All right. Number one, Qualcomm, $21.2 billion. After spending $1.1 billion from March through June, Qualcomm spent a staggering $21.2 billion on share repurchases between June and September. That's the third highest quarterly spending on buybacks in S&P 500 history, and it brings Qualcomm's total buybacks to $44.2 billion over the past 5 years. The chipmaker's buyback wasn't a surprise. Qualcomm announced a $30 billion repurchase plan earlier in the year, following the scuttling of its $44 billion acquisition of NXP Semiconductors by regulators. And in September, it said it spent $16 billion buying back shares from investment banks, including Bank of America and Citibank. The chipmaker's sales were $5.8 billion in its fiscal Q4, ending September 30th, and it came into the current quarter with $8.9 billion remaining on its buyback authorization and $12.1 billion in cash. Since the company generates over $1.2 billion in adjusted net income per quarter, it has plenty of cash to support future buybacks, but I wouldn't expect its next authorization to be as big as this one was, not including this fiscal year. It spent an average of $3.76 billion on repurchases per year since 2010. The one wild card to watch, though, is Qualcomm's ongoing suit against Apple, claiming Apple owes royalties on sales of devices using its intellectual property. Depending on how this suit pans out, it could impact Qualcomm's future buyback activity. All right, and then we got Apple at $19.4 billion. Apple repurchased $21.9 billion in stock from March through June, and it followed that up by buying $19.4 billion additional shares from June through September. It was the fifth most ever spent by an S&P 500 company in a single quarter, and Apple now has the distinction of being responsible for 7 of the 8 biggest quarterly buybacks in S&P 500 history. Over the past 5 years, Apple has spent $224 billion on buybacks, including $75.2 billion in the 12 months ending September 2018. Significant sales growth for its customers, for its consumer electronics devices and high-margin services, including the App Store and iTunes, has financed all those repurchases in its fiscal fourth quarter ending September. Apple reported that sales grew 20% year over year to $62.9 billion, including a record $10 billion in services sales. Okay, well, anyway, point is, there is a lot of stock buybacks going on with these companies. So, stock buyback. All right. Why would a company buy back its own shares? Investopedia. Stock buybacks refer to the repurchasing of shares of stocks by the company that issued them. A buyback occurs when the issuing company pays shareholders the market value per share and reabsorbs that portion of its ownership that was previously distributed among public and private investors. With stock buybacks, aka share buybacks, the company can purchase the stock on the open market or from its shareholders directly. In recent decades, share buybacks have overtaken dividends as a preferred way to return cash to shareholders. Though smaller companies may choose to exercise buybacks, blue chip companies are much more likely to do so because of the cost involved. Reasons for buybacks. Since companies raise equity capital through the sale of common and preferred shares, it may seem counterintuitive that a business might choose to give that money back. However, there are numerous reasons why it may be beneficial to a company to repurchase its shares, including ownership consolidation, undervaluation, and boosting its key financial ratios. Unused cash is costly. Each share of common stock represents a small stake in the ownership of the issuing company, including the right to vote on company policy and financial decisions. If a business has a managing owner and 1 million shareholders, it actually has 1,000,001 owners. Companies issue shares to raise equity capital to fund expansion, but if there are no potential growth opportunities in sight, holding on to all that unused equity funding means sharing ownership for no good reason. Businesses that have expanded to dominate their industries, for example, may find that there is little growth to be had. With so little headroom left to grow into, carrying large amounts of equity capital on the balance sheet becomes more of a burden than a blessing. Shareholders demand returns on their investments in the form of dividends, which is a cost of equity. So the business is essentially paying for the privilege of accessing funds it isn't using. Buying back some or all of the outstanding shares can be a simple way to pay off investors and reduce the overall cost of capital. For this reason, Walt Disney reduced its number of outstanding shares in the market by buying back 73.8 million shares, collectively valued at $7.5 billion back in 2016. It preserves the stock price. Shareholders usually want a steady stream of increasing dividends from the company, and one of the goals of company executives is to maximize shareholder wealth. However, company executives must balance appeasing shareholders with staying nimble if the economy dips into a recession. One of the hardest hit banks during the Great Recession was Bank of America Corp. The bank has recovered nicely since then, but it still has some work to do in getting back to its former glory. However, as of the end of 2017, Bank of America had bought back 509 million shares over the prior 12-month period, and the bank plans to return over $17 billion to shareholders through share repurchases in 2018. Although the dividend has increased over the same period, the bank's executive management has consistently allocated more cash to share repurchases rather than dividends. Why are buybacks favored over dividends? If the economy slows or falls into recession, the bank might be forced to cut its dividend to preserve cash. The result would undoubtedly lead to a sell-off in the stock. However, if the bank decided to buy back fewer shares, achieving the same preservation of capital as a dividend cut, the stock price would likely take less of a hit. Committing to dividend payouts with steady increases will certainly drive a company's stock higher, but the dividend strategy can be a double-edged sword for a company. In the event of a recession, share buybacks can be decreased more easily than dividends, with a far less negative impact on the stock price. The stock is undervalued. Another major motive for businesses to do buybacks. They genuinely feel their shares are undervalued. Undervaluation occurs for a number of reasons, often due to investors' inability to see past a business, short-term performance, sensationalist news items, or a general bearish sentiment. A wave of stock buybacks swept the United States in 2010 and 2011 when the economy was undergoing a nascent recovery from the Great Recession. Many companies began making optimistic forecasts for the coming years, but company stock prices still reflected the economic doldrums that plagued them in prior years. These companies invested in themselves by repurchasing shares, hoping to capitalize when share prices finally began to reflect new, improved economic realities. If a stock is dramatically undervalued, the issuing company can repurchase some of its shares at this reduced price and then reissue them once the market has corrected, thereby increasing its equity capital without issuing any additional shares. Though it can be a risky move in the event that prices stay low, this maneuver can enable businesses who still have long-term needs of capital financing to increase their equity without further diluting company ownership. All right, and then finally, it is a quick fix for the financial statement. Buying back stock can also be an easy way to make a business look more attractive to investors. By reducing the number of outstanding shares, a company's earnings per share ratio is automatically increased, because its annual earnings are now divided by a lower number of outstanding shares. For example, a company that earns $10 million in a year with 100,000 outstanding shares has an EPS of $100. If it repurchases 10,000 of those shares, reducing its total outstanding shares to 90,000, its EPS increases to $111 without any actual increase in earnings. Also, short-term investors often look to make quick money by investing in a company leading up to a scheduled buyback. The rapid influx of investors artificially inflates the stock's valuation and boosts the company's price-to-earnings ratio. The return on equity ratio is another important financial metric that receives an automatic boost. All right. Keep going. Downside of buybacks. A stock buyback affects a company's credit rating if it has to borrow money to repurchase the shares. Many companies to finance stock buyback. Many companies, choose to finance stock buybacks because the loan interest is tax deductible. However, debt obligations drain cash reserves, which are frequently needed when economic winds shift against a company. For this reason, credit reporting agencies view such financed stock buybacks in a negative light. They do not see boosting EPS or capitalizing on undervalued shares as good justification for taking on debt. A downgrade in credit rating often follows such a maneuver. Effect on the economy. Despite the above, buybacks can be good for a company's economics. How about the economy as a whole? Stock buybacks can have a mildly positive effect on the economy overall. They tend to have a much more direct and positive effect on the financial economy as they lead to rising stock prices. But in many ways, the financial economy feeds into the real economy and vice versa. Research has shown that increases in the stock market have an ameliorative effect on consumer confidence, consumption, and major purchases, a phenomenon dubbed the wealth effect. Another way improvements in the financial economy impact the real economy is through lower borrowing costs for corporations. In turn, these corporations are more likely to expand operations or spend on research and development. These activities lead to increased hiring and incomes. For individuals, improvements in the household balance sheet enhance chances they leverage up to borrow to buy a house or start a business. Okay, so now we know a little bit more about stock buybacks. The point in the future for investors, right, is that if the government chooses to tax dividends more heavily, and dividends are like a way that companies give cash back to investors, then it may be better to inflate the price of the stock by doing a stock buyback, because investors are not taxed on the inflated price of the stock until they actually sell the stock. So it's a way of avoiding capital gains tax for the actual investor. And so therefore, over time, the investor is going to get more value about that because, especially if it's compounding over time. All right. Well, that is it for 5-Year Club video number 345. I hope you enjoyed it. Hope you enjoyed on this this was a terrible day in the stock market. I hope you enjoyed learning about stock buybacks. When you see them in the news, I hope it means a little bit more to you. It has a little bit more color than it would otherwise. And have a fabulous evening.